Yeah. So we can now move on to a lot of people are active sort of investors and prefer like owning shares themselves. Generally, unless you are an expert investor, this does not beat index. So like in terms of historical returns. But if you do sort of own shares or want to own shares of blue chip companies or otherwise, there is taxability for that as well. And there is also a lot of sort of pain in terms of onboarding, which we will also cover. But let's cover the taxability part first. Yeah, Jaydeep.
Uh, yeah, so I just forgot to mention something in the interest taxation part. The tax rate for the interest is as per your ordinary slab rate in India. However, if you are living in a country that's a double taxation avoidance agreement, there could be a lower rate at which you could be taxed. That you will have to mention in your tax return in India. Okay, let's go ahead and now look at FEMA compliances for investing in listed equity on the Indian stock exchanges. Like Nishad mentioned, you will need a non-resident demat account, and expatriates from India may have a resident demat account already, but that generally is not convertible to a non-resident account. So you probably will need a new demat account and transfer your holdings to a new account. Most people, however, continue investing through resident demat accounts, which is a clear violation of the FEMA provisions. So if you do that, then it is a violation and you need to convert to a demat, that is a non-resident demat account. Now, for investing in shares, how can you bring the funds to India? To invest on repatriable basis, you can bring funds directly to your brokerage account uh, by inward remittance or from an NRE account. For non-repat investments, you can bring funds from either NRE, FCNR, or NRO accounts, or directly from your foreign account as an inward remittance. Sale proceeds always net of taxes. So sale proceeds, whatever you sell, whether it is a mutual fund, whether it is a share, whether it is your interest income or dividend income, it is always repatriable after taxes. Now, sale proceeds after taxes of repatriable investments gets credited to NRE account, or you can take it out through outward remittance directly from your brokerage to your foreign account. For a non-repat investment, they will get credited only to NRO account. Like I mentioned when I was explaining the bank accounts, NRO accounts are the route for non-repat investments. So if you invest on non-repat basis, sale consideration or any income will generally be credited to your NRO account only. You cannot not allow it to be credited to your NRE account in any situation. Uh, Now, when we talk about non-repatriable investments, though the investment is a non-repatriable investment, current income, that is income on which you have paid tax from that investment, is always remittable outside India from your NRO account. You may have to prove it to the bank that this is income on which tax has been paid by way of a certification, like I said. But there is also a $1 million USD 1 million scheme for remitting non-repatriable investments or any other funds that you have outside India. This is applicable for NRIs and OCIs and for certain other persons, but those are specific conditions. So for NRI OCI, you can remit up to USD 1 million out of India for Indian financial year. This limit is for Indian financial year. So from April to March, you have a limit of USD 1 million. Now let's go ahead and talk about the taxation part. So non-residents are taxed on equity-oriented mutual funds. We already discussed that, and listed shares. Basically, both the investments are mirrors. So for taxation purposes, if you invested in an equity-oriented mutual fund or you invested in a listed share, the tax structure is identical. So short-term capital gains result when you have held your shares for less than 12 months, taxed at 15% if they are sold on the stock exchange. Long-term capital gains are taxed at 10%, again, 10% without indexation. It's the same thing again up to January 31st, 2018, India did not tax long-term gains. So if any gain is there or if any loss is there, that gain is exempt and that loss is disallowed. Dividends from equity shares are taxed at slab rates. So the slab rate determines your tax rate. Same thing again, tax deduction will be applicable on gains and on dividends. Again, double taxation agreements with various countries could lower that tax rate. That is the same over here as well.